Hello, and welcome to this week's edition of Tax in 10 with me, Rachel.desouza, and Andrew Robins.
Rachel, one of my friends is in the process of selling all of his shares and reinvesting in a fixed 2-year bond, and he asked me what I thought about this. Now, obviously, I said, I think you need to talk to somebody who actually understands investments and not a tax advisor. But this is something we're seeing quite a lot of at the moment, so I thought it would be worth us exploring it a bit more today. As tax advisors, we generally hate it when people start talking to us about their investments because it's just so easy to blur the lines between tax advice where we know what we're doing and investment advice that we're definitely not qualified to give. So let's try hard to stay on the right side of the line, but I think there are definitely some themes worth us exploring.
Yeah, no, that's true. So why don't we start with the question of whether to invest at all? I know a lot of my wealthier and less risk-adverse clients. I mean, they've had a long period of activity where they've been borrowing money to maximize their investments. And of course, when interest rates were 2%, this strategy looked pretty good.
Yep.
Although I do think the tax element was often forgotten. Today, with interest rates being much higher, it's a really live issue. And I guess it's probably easiest to explain with a simple example. So let's pretend that I pay tax at 40%, but I borrow £100,000 at 2% interest rate.
Mhm.
If I could invest that £100,000 and generate income of £3,000, so, a 3% return, on the face of it, it feels like I've made a profit of £1,000.
Yeah, of course, as Killjoy tax advisors, this is where we jump in and say it's not as simple as that, because the £2,000 interest I pay on the loan comes out of taxed money, and the £3,000 interest I receive is subject to income tax. And since we're a 40% taxpayer, that's £1,200 of tax. So after tax, you're actually £200 worse off in your example. Now, this didn't matter when your investment yield was significantly outstripping your investment cost, but it's a very different story today. And with interest costs close to or even exceeding investment returns, having a loan as part of an investment strategy currently feels like very bad news from a tax perspective.
Yeah, but let's turn that around because actually a lot of the clients are looking to pay off their debt rather than take out more debt. As an example, I recently advised someone who wanted to use his pension pot to pay off his mortgage. So let's have a look and see if that makes more sense. So in a simple case, if I have £100,000 of cash and £100,000 of debt, my choice is either to pay off the loan or to invest.
Yep.
Now, paying off the loan effectively gives me a guaranteed return on my money. So if interest rates are now 5%, the loan repayment is effectively making me £5,000 per year better off. But on the other hand, if I invest the money, I would need to get an investment return of 8.33% in order to get that same net £5,000 of benefit because of the need to pay 40% tax, in my example. Now, that doesn't necessarily mean that you shouldn't invest the money and you should just pay off the loan, but it does mean that you need to be targeting much higher returns for this strategy to make sense. Now, of course, if you're a 45% taxpayer, then the difference is even greater.
I guess I shouldn't be, but I am always surprised how often clients don't appreciate that point. I think it's worth having the conversation with anybody who has substantial levels of borrowing at the same time as having investment assets. Of course, you do need to bear in mind, though, that if you're actively selling assets to pay off debt, you'll pay tax on any profits you realize on those disposals, which complicates the calculation even more. So, again, as an example, if you receive an inheritance in cash, it's easy to work out how much you can save by paying off your loan. But on the other hand, if you take a pension lump sum like your client, which is largely going to be taxable at 45%, you need to take account of the tax costs on that as well as the tax savings to work out whether it's actually a good idea. I mean, we have talked so far about whether you should be investing at all when you also have debt. But the start of this conversation was thinking about bonds versus equities. Now, aside from the fact that the phrase just reminds me of the not very good Harrison Ford film Cowboys versus Aliens, what is the significance of bonds versus equities?
Oh, for heaven's sakes. Now, let's ignoring your poor choice of films to watch. From a tax point of view, the big difference is, of course, the tax rates that you pay. But there is a wider issue about risk. And I'm absolutely not going to get into the territory of comparing investment risk and reward. But as a rule of thumb, term deposits or bonds where you have a guaranteed interest rate and you receive a fixed interest rate on maturity are much less volatile than shares paying dividends. So if we ignore the risk of financial collapse, I mean, a 2-year 5% bond would create a predictable investment return for me, whereas shares could make me much more or much less, but that's going to be dependent on the market. Now, from a tax point of view, and again in general terms, bonds are a little bit less attractive than shares. With a bond, you're going to pay standard income tax rates on the interest of 20%, 40%, or 45%. Whereas we have these really peculiar dividend rates, which are 8.75%, 33.75%, and 39.35%. And in addition, of course, if you make the capital gain on your shares, as you mentioned earlier, you'll pay tax of 10 or 20% in the normal way. Whereas with most bonds, you just don't make a gain. You can't make a gain. Although, of course, you don't risk losses in the same way that you would do with shares.
So this is where I think as tax people, we have to tread really carefully because we're just not competent to balance all of the investment issues to tell clients what's best for them to do. It seems fairly clear that bonds or fixed deposits give you a predictable result. And with interest rates high, the returns can seem attractive, but you still have to think about the real value of money after inflation. And for some people, it's still going to be worth taking that riskier equity approach.
Yeah, no, absolutely. And this really is where IFAs and investment managers, come in and earn their money. Although I imagine it involves a blizzard of spreadsheets. No, and I think really the upshot here is that, as in a lot of areas, what clients really need is a combination of both investment and tax advice, rather than just looking at the thing in isolation. Yeah. So on that note, Andrew, have you got a recommendation for us, which isn't a rubbish film, please?
I do. I have a computer game recommendation instead.
Oh. Okay, go on then.
She says, Baldur's Gate 3, which, and you will love this, Rachel, it's just so much your thing. It's a role-playing game based on Dungeons and Dragons tabletop rule set. It is absolutely fantastic. It's all about sort of relationships between characters. You've got huge freedom of choice. The coding of this thing is astonishing because every decision you make changes the outcomes and changes the whole effect of the game. So it's got kind of endless replayability. But I am having an absolute whale of a time with it. Baldur's Gate 3, thoroughly recommended.
Okay. All right then. Well, anyway, thank you for listening to us. Now that's me, Rachel D'Souza, and Andrew.Robins, both tax partners at RSM. Do let us have your comments or feedback, and we can be contacted on rachel.desouza@rsmuk.com or andrew.robins at rsmuk.com. Anyway, until next time, bye for now.
Bye.